Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 that really has kept investors on edge over the past few weeks. This has been the fifth red week in a row, fifth consecutive red week that we've seen on the S&P 500. I believe that hasn't happened since 2011, right? So it's very rare to get so many weeks in a row that are red. I'm sorry, just as I'm seeing this chart here, I can spot 5 red weeks in a row in the COVID crisis here. But the point is, it doesn't happen very often. We have this head and shoulder pattern. And from a macro standpoint, we've just had a yield curve inversion, right, which is a typical leading indicator of recessions. It tells us that a recession is going to be coming in the next year or two. We have inflation at levels that we haven't seen in decades. And we have a Federal Reserve that's tightening money, tightening liquidity like never before, with a stock market that has really had tremendous returns over the past 10, 15 years. And we know that when there is a period where the market goes up for 10, 15 years, that's usually followed by a period where the market doesn't perform too well over the next 10, 15 years. Now, the question is, did we already see the top? Was January 2022 the top of the stock market, or is there more upside? That's exactly what we're going to talk about in this episode. If you're interested in following these crazy markets with us, make sure to smash that subscribe button. Do not forget to click on the like button if you enjoy the research that we put out free for you guys. It is really appreciated. And now, without further ado, let's get right into it. Okay, so first of all, if you haven't seen all of our recent videos, we've really developed a bullish case for the stock market. We've taken a look at a huge number of indicators that are pointing to the fact that this may be a low, that this may be a local bottom, and that we'll be rallying from now on. We've taken a look at things like the put-call ratio that spiked to levels that we haven't seen since the COVID-19 pandemic. That means a record amount of market participants are betting on puts for the markets to go down. That's something that doesn't look at all like what we've seen throughout this period here, and actually often corresponds to big lows in the market when you have this type of panic, and at the very least multi-week periods of consolidations, right? For example, in that 2018 example, in this capitulation bottom, put call ratio was very high, led to a massive run. And then all of these local bottoms also saw a record amount of short interest in the market. Now, if we take a look at one of our previous articles that we posted last week, we really highlighted the macro bullish case for the stock market right now. Now, let me just zoom in here so that you can see this chart properly. The yellow bars here are the earnings. Now, earnings, we know, drives the stock market. When you have elevated earnings growth, so that yellow line is going up, you're going to see the stock market rally because it means that the stock market is more profitable. Now, the blue line is valuations. It's the PE ratios. So for that same earnings number, how much are market participants willing to pay? When it's very low here, it means there's a lot of fear in the market and that investors are not willing to pay a premium. A very good example is that 2018 correction here. The Fed had been tightening very aggressively since mid-2017. QT started late 2017. And so that created a lot of fear in the market. And you can see towards the bottom of this correction, PE ratios had come down very significantly. But then in 2019, as earnings were rolling over and economic strength was actually rolling over, we were heading into a recession. We had just had a yield curve inversion. The dollar had been strong for quite some time. Oil had been rallying for quite some time. So a lot of things were pointing to weakness in the economy in 2019 and 2020, even before the pandemic hit. But despite that, the market rallied. And the biggest reason for that is PE ratios were actually going up throughout that period. And so we discussed our entire thought process behind this in this article, exactly why we think that's going to happen. We took a look at several examples, several historical examples, and the primary argument for that is that we expect the 10-year yield to top very soon. And once it does top, you can see, for example, in 2006, it topped right here in July 2006. And in 2018, it topped right here in October, November 2018. Now, if we take a look at PE ratios in these periods, you can see you had an expansion in PE ratios throughout both of these periods as yields were going down. So investors were willing to pay a higher premium for stocks because yields were coming down. And so valuations were going up, even though in both of these cases, economic weakness was almost guaranteed in the future, right? You had a yield curve inversion in both of these cases. You had seen oil being very strong leading up to both of these cases. Manufacturing indexes were starting to point down in both of these cases. And yet, the market managed to rally significantly. And this is the type of move that really leads to massive market tops, right? It's what led to the 2007, 2008 market top. And so as we get the 10-year yield, that's just been absolutely massively rallying here, a lot more than what we were expecting. You can understand why these PE ratios have been absolutely plummeting over the past few months. Right now, the 10-year yield is overextended like it has never been before. This is the percentage difference between the 10-year yield and its 50-week moving average. And you can see the 10-year is rarely more than 25% above its 50-week moving average. And when it does reach that level, that typically marks a big top, like in 2013, like in 2017, even like in 2021 here. You had a massive pullback back to that 50-week moving average. And you can see as we speak, we're very, very overextended like never before. So when that happens, you can expect a move back to retest that moving average. That would put a retracement on yields back to this level of support at around 2% at the very least, right? We expect this to be a cycle peak in government bond yields. But for those who don't agree with that and that still expect that they can go higher in the months ahead, even in that case, you should be expecting a pullback from current levels because they are so overextended. So in that case, you really do fall into that scenario that we've been discussing. Now, this stuff is absolutely essential to understand. They don't talk about that on the news, on the media, and that's why there's very few individual investors that are really able to make money in the market. That's really the goal of gameoftrades.net. We work absolutely relentlessly to master these markets, to master these cycles, these movements, and how to position properly in these markets and not get caught up in the short-term narrative, remain objective in our own thesis to help you guys actually have an edge in this market. And so every week, multiple times a week, we look at these indicators, we reassess our thesis and how we should be positioned so that you guys can just get on the site and catch up to all the research, catch up to everything that's been going on, and hopefully take decision with an additional edge that's going to help you increase your market returns. Now, one concern that I do have right now is that I did expect the 10-year yield to turn around a lot sooner. You can see it's spiking right here. It's spiking. It continues to rally very strongly despite its overextension. Now, things can remain overextended for a long period of time, but eventually it does revert back to that moving average, to that mean. But if the 10-year continues to spike, especially if we get, for example, a CPI reading this week that's a lot hotter than what the market is expecting, if inflation continues to grow stronger here, that could lead the bond market to continue falling, yields to continue spiking, and that could ultimately bring down the stock market for one final capitulation move down, right? If we take a look at the breadth of the stock market, that tells us how oversold or overbought the market is, we could still have a little bit more downside left, right? In 2018, that capitulation move went all the way down to 11% of stocks being above their 200-day moving average. So you do have that gap that is scaring some investors that the market could go for one capitulation move down. And, a bad CPI reading, that could cause that type of move. Now, I personally think CPI is going to start to cool off over the next few months. If we take a look at the breadth on the tech sector, we're a lot closer to those oversold readings that marked massive bottoms. So yes, we are seeing a lot of signs that the market is very close to a bottom, a lot of extreme bearish sentiment, but one final capitulation move down, that's not completely out of the question. That's not what we're betting on right now. If we take a look at the VIX, for example, I'm going to take a look at the VIX and show you guys this recent development where you can see you have these VIX highs, 1, 2, 3 lower highs systematically, 1, 2, 3 lower highs. And yet what's the market doing? 1, 2, 3 lower lows. That's not what you want to see if you're a bear. You want to see the VIX be breaking out here. You want to see the VIX close above this trend line, and that's when you can get that capitulation move. That's not what we're seeing here. The bulls are winning this volatility fight. And again, I can show you how it works in the opposite direction. Market is making higher highs throughout the end of 2021, and yet the VIX is making higher lows, telling you that this is going to be a significant top. We were looking at this back here in 2021. Now, again, this is the goal of the service. We actively watch these things that you don't have to, and also you don't make the mistakes that we've made in the past. I can't tell you how incredibly difficult it was of a journey to become profitable in the market, to understand how the game works. And Game of Trades is all about letting you avoid that same pain and get access to the right research that's going to actually give you an edge in the market. We look at a crazy amount of data, a crazy amount of case studies from different periods in history. So obviously we are at an inflection point here. I think, again, the big event to watch this week is the CPI reading. If it surprises to the downside, I think we break out of this wedge pattern, we head to the all-time high. That's a very likely scenario. And if it surprises to the downside, well, we could break down. And that's when we'd be officially in bear market territory. We're going to talk about that in an article next week. If we start to get big technical breakdowns, for example, below the 100-week moving average, if we get that type of breakdown, similar to what happened in 2007, and you do get that move down while you are in a bear market, and then you're looking to exit your positions on that next bear market rally. Because again, right, if we do break down, the low isn't far. It's not like if we break down here, we're heading straight into a 50% drop. There's going to be massive opportunities to get out of the market in a very profitable way. And again, just to reiterate, if you watched our last video, you'll know that we don't expect this type of scenario to break down. Intermarket analysis is just not telling us that this is what we should be anticipating. But a big rule in trading and investing is be prepared for all scenarios. Be prepared to be wrong, because nothing is 100%. One of our objectives at Game of Trades is to be as transparent as possible in what we're seeing in the market. And so just yesterday, I posted this article here on the CPI reading that's going to be released tomorrow. And we take a look at a bunch of different indicators and developments that we've had, like the base effect, commodity returns over the month of April, the current consensus estimates, and a bunch of other metrics that we look at that gives us an edge before this report comes out, and of course how we think that's going to impact the market. And then later this week we are going to be posting an article covering the details of our strategy looking out over the next few weeks. If we rally from here, what kind of indicators are we looking at to identify whether this is going to be just a bear market rally or whether we should be expecting much higher highs in the market? I think these are very important questions that a lot of people are asking. So if you are interested in having access to that research, make sure to go to our website at gameoftrades.net. So I hope you guys enjoyed this video. If you did, make sure to smash that like button as hard as you can if you appreciate the research we put out. It does take a lot of time, a lot of effort, putting this out for free, putting this out for you guys. So make sure to let us know by clicking on that like button. Now, in the meantime, I wish you good luck on your trading and see you next time.